you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and more bulls in the real estate market are starting to shift their tone to prices are going to crash and go down in 2024. This is especially intriguing considering the fact that most bulls and most real estate investors are completely out of touch with normal human beings. So it's really exciting to start to see this. And what we're going to do today is we're going to do a reaction video from an interview that someone named David Lynn did with Glenn Kelman, which is the CEO from Redfin. Now, real quick shout out to David Lynn. If you guys don't know who this guy is, go to his YouTube channel, David Lynn. This guy's an absolute stud. He's an absolute beast. I really enjoy listening to his content. So big shout out to him, but it is his interview. Wanted to acknowledge that. Now, we're going to listen to 3 sections of this interview. The first section is going to go into whether or not Glenn feels that home prices are going to decline, which he does. And then the second thing is he's going to give his advice, really pinpoint what he's thinking as far as what the government should do to help fix the housing market, even though you could argue the reason why we're in this mess is because of the government trying to fix the markets. Now, the third section is going to be about unaffordability. And I think that Glenn's not a stupid person. I just think that he's being paid to be bullish. So he's got some good perspective. And honestly, the last time I heard him so conservative, the video was deleted from YouTube. So it's really nice seeing that Redfin is allowing him to be more cautious. Now, before we start the first section, do me a favor, guys, like the video, subscribe if you haven't already, shoot me some comments below, hit notifications, and understand this. I hate asking that every single time I have to. I'm a YouTuber, I'm a grown man asking you to subscribe. And trust me, guys, I hate it more than you. So if you can, one more time, hit like, subscribe, and enjoy this video.
The first prediction you have in this report says home prices will fall 1%. First of all, is that across the board or is this select jurisdictions?
I think some markets will have larger losses and other markets may go up. But for the first time in a long time, we see more inventory headed to the market in the first quarter of 2024. And that should create some relief for home buyers who are looking to catch a break.
This report was written or published right before the Fed announced that they're possibly done rate hikes. We're expecting at least 3 cuts next year. Did that announcement spark any revisions to your forecast?
I think we're more bullish on home buying demand. So what led to the forecast is that so many people have been contacting us. We're a real estate website, one of the top sites in the United States, but also a real estate broker. And so many people had contacted our agents saying, I want to put my house on the market in January. What do I have to do now to get it ready? And I have been on every news channel in the US saying that real estate is dead as a doornail. I don't see any light at the end of the tunnel. It is a whale turd at the bottom of the ocean. And now there is some light at the end of the tunnel because for the first time, we aren't seeing a massive amount of listings, but a significant amount of listings. That's what led to the report. And then subsequent to that, this interest rate drop, which was quite significant, happened. So maybe demand will meet there. That means that maybe prices won't fall quite as much, but sales volume is definitely likely to go up. If you look at mortgage purchase applications over the last 6 weeks in the United States, that's up about 19.5%. So we do think that rates could go up again. The Fed is already being criticized for acting too hastily. The economy is still hot. Retail sales are really strong headed into the holiday season. So it's anybody's guess what will happen. But the one thing that we're sure will change is we think that more inventory will come to an inventory constrained market.
So to recap what he was saying is basically, like we know for sure now, it's market specific. Some markets are going to perform way differently than others. And even within those markets, remember what I've been trying to teach you, it's going to depend on the subdivision. Some subdivisions will perform completely opposite of one another. The key to investing and making the right decision, a sound decision when purchasing your house, is understanding how the data works and, preferably not using your emotions to buy houses, right? Using fundamentals like, having equity in your house known as something like wedge, or having your payment low enough to where you can cash flow, basically a hedge if you are ever forced to move, something I didn't have when I lost my house in 2008. So those are some of the fundamentals, but I also want to acknowledge a few of the other things that he said, which is essentially that the golden handcuff effect, the phenomenon of golden handcuffs, which was here in the 70s and 80s, is fixing to be crushed in 2024, especially potentially depending on how low rates go. Personally, I feel like the lower the rates go up to a certain point, okay, the more inventory we'll actually get. I think, a little 25 basis point rate cuts are electionary rate cuts, to be honest with you. So it's going to be interesting to see what happened. But I will say the fact that this man works for a company that's a boots on the ground company is important, because what he's saying is he's getting more interest right now in people selling their houses versus purchasing a house. That's very, very interesting if we really think about what he's saying. And then also he made a claim that mortgage applications is going up 19% and these types of things. But the reality is mortgage applications are not going up. Even though rates went down about 150 basis points, 140, 150 basis points, which is basically 8 to 6.5, mortgage purchase applications are going down, as is demand, not up. And I understand it's the winter season and usually it goes down this time. But again, I'm not the one on the sidelines saying, oh my God, there's all these people going to buy. Oh my gosh, oh my gosh. Take a look at the mortgage applications. This is a Housing Wire article titled Mortgage Applications Fall. Okay, they fall despite mortgage rates declining. I'm sorry, it's the reverse of that. Despite declining mortgage rates. But total home loan applications, you guys, decreased by 1.5% for the week ending December 15th. They did not go up. They went down. And when we look at the type of loan applications right here, it paints a different picture. This is not going into conventional, but the share of FHA loan activity decreased 15.5%, down from 16.1 the week prior. The Department of Veterans, or VA, loan activity was down 15.6%, up from 14.2% the previous week, and the USDA loans is unchanged. So the narrative is quite the opposite of what most people think. Now, and again, I'm going to tell you guys right now, if the rates go down 100, 200 basis points, I actually think that will help create a housing market crash, with the assumption that the only reason they would go down 100 to 200 basis points is if we have some type of economic turmoil. I think it's commercial real estate. To me, it's obvious it's commercial real estate. We'll see how that plays out in the future. Let's go back into the video and get more of his thoughts.
Already falling as we speak. In fact, they probably already happened, which is why they're being reported as news, or events that have already happened. Newsweek, for example, reported that homeowners lose $122,000 on average as housing prices drop. New homeowners, I'll just read you a paragraph. New homeowners across the U.S. are confronting a rapid depreciation in their home values. Recent data showing an average loss of $122,000 in home value in some areas. The American dream is showing signs of wear, says. Is that a data that you're observing as well, that we're seeing rapid depreciation in home values, is in their words?
I just feel more careful about it. And it's not because I'm a real estate broker. I've been a long advocate for lower home prices. It's just that rates fell from 8 to 6.5. And the number of people piling onto our website, looking at listings over just the last 7 days, has really gone up. And so even my own feelings about whether home prices could soften have changed. I do think that the builders, when they sell new properties, that has gotten a little bit bubbly because there's so few existing homes for sale. The builders have been able to command a premium, and then sometimes you have some buyers.
Prices are the same, by the way.
But for the most part, I haven't seen kind of precipitous declines that I saw in 2008. In 2008, I bought my own home at the very bottom of the market. It was 30, 40% off. I just haven't seen that here. What we are seeing is it's really hard right now to put buyers and sellers together. We're in the business of putting deals together, and the buyer is looking for $100,000 off, and the seller is willing to give $5,000 off. And that always happens, but usually the gap is $10,000 or $20,000. And right now the gap is really large. And that just speaks to the volatility of the market, where everyone is feeling a high degree of uncertainty. And if they're going to do a deal, they're going to try to do it on their terms. So it's been really hard to put deals together.
All right, so a couple things there. I want to go in and show you actually that touring activity, demand, and mortgage purchase applications are down according to his own data and his own website. So don't really know why he's saying that, because he's wrong about that. And I'm going to show you guys. But I also want to point out that buyer's remorse is coming from existing homes, not necessarily new construction. It's existing homes. So he is a bit out of touch. I understand he's always going to try to be bullish, but it really frustrates me. It's especially existing homes. Okay, buyer's remorse is especially in existing homes. Yes, in new construction for sure, especially when quality of construction is looked at, but most of it's existing homes. And when we talk about the gap between seller and buyer, can't we say that that's the bubble, Glenn? Can't we just say that that is the bubble? Right? I mean, come on. And then what I was trying to say earlier is the prices, the median sales price for existing and new construction are almost the same. So how could new construction be in a bubble, but existing is not? It's because of lack of inventory. Is that what you're saying, Glenn? Just be specific is all I'm saying. Be specific. Okay, so here's the most recent report from Redfin, and this is as of December 14th. So I'm not sure if he had this data. I would assume he had this data, but look at guys, touring activity is down 38% from the start of the year as of December 14th. At this time last year, it was down 45% from the start of 2022. So there is no increase. They're showing no increase. We've seen mortgage applications go down as well. Let me show you guys demand. And again, you guys, this is his own data that I'm using here. Now, demand for 2023 is the orange line you can see here. So I just wanted to point out that demand right now to purchase houses is the lowest it's been in 4 years for this time of year. You can see that obviously it was worse during lockdowns right here, but I'm saying for this time of year in December, it is at a 4-year low. In fact, it's down 7% year over year. So pretty crazy claims that he's making when the own data that his company reports is telling us otherwise. And I'm going to tell you guys right now, quite frankly, what's happening, and we saw this happen in 2007, people are getting sick and tired of talking about the housing market. They're getting sick and tired because we know that houses are overpriced. People are starting to want nothing to do with it. That's a good thing. And that's a bad thing because most people will give up on themselves and will give up hope, which unfortunately, you guys, is what needs to happen and what they want to happen. But what I'm saying is it doesn't have to happen to you. Hold on to your hope, keep working on your purchasing power, and be proud of yourself for doing so.
Young or old.
Yeah.
I'll give you some things that here in BC, British Columbia, where I live, that the government has tried to do. They've raised taxes on buying from foreigners.
Yes.
They've installed
a lot.
A lot. They've installed an empty home tax. You can't leave a home vacant. And now, as of November, they're proposing to not ban, but change zoning so that more multi-unit homes are being favored. So basically incentivize more multi-unit homes, less and fewer single-family homes. Are these the right policies? Will these make a difference, Glenn?
I think so. I mean, they've definitely made a difference in Vancouver. Housing prices have really fallen in Vancouver, and sales volume is significantly down, even though immigration to Vancouver is really strong. Here are some things that you can do. Number one, the municipality, the county, even at the neighborhood level, there are all these restrictions around what you can build, and the federal government just needs to nuke all of it. We need to be explicitly pro-builder. The left, which wants low home prices and affordable housing, needs to embrace builders. They hate each other right now.
Interesting.
For 50 years, mayors wouldn't be caught dead at a ribbon cutting ceremony with a builder. But we need to figure out everything we can to build not just a few more houses, but millions and millions of more houses in the United States. So that's one. And then I think the other thing is that rates are just so volatile right now, not just for consumers, but for builders. If you've got 5 years to get something permitted and built and sold, and in that time, your cost of capital is going up and down, many builders are leaving the business, or they aren't being as aggressive as they could be about building for volume. They're being very selective and doing a small number of units at high margin. And so there should be an industrial policy to provide more stable financing to builders who want to build large amounts of housing. That would be the second thing that I would do. And then the third thing, if I'm just on a roll, and I'm not sure that I am, is, you can offer all sorts of incentives. In the Great Recession, there were new homebuyer incentives. It's clear to me that, a 29-year-old American could benefit from that today. There are so many government entitlements that go to people who are 70 years old, and there are so few that go to people who are starting a family 30 years old. That would be my last thing if I were king for a day.
All right, guys. So tell me what you think. So his 3 solutions that the government needs to start doing is, now the first one I believe is supporting new home builders by deregulating certain zoning and things like that. Now, I think that could be good possibly in areas like Anaheim, San Diego that are incredibly dense, but in areas like Texas, Phoenix, Las Vegas, we got so much land. If anything, we need more regulation with new home builders. Consumer protections in new home building is just, it's just trash, you guys. It's like the wild, wild west. It's the difference in consumer protection from existing to new homes is enormous. So I'm not 100% sold on, less regulations for new home builders, but let me know what you guys think. Does the government need to support new home building more? I think they do, actually. I think the more new home building, the better, but not less regulation, more potentially incentives. Now, his second thing is, I believe what he was saying is they need to hold the rates steady and stop moving the rates all over the place, which actually that ended up being a good thing for them when the rates were 2 and 3%. They've actually made a killing this entire time. So let me know what you think about that. So no more lowering and raising interest rates. Honestly, that's not a bad idea, because remember, guys, we're in this mess because rates were too low for too long, plus the money printing and the stimulus and the PPP and the IDL loans and all of that type of stuff. But it was because the government got involved. Now, the last thing that he said is there needs to be more incentives for first-time home buyers. I think he's drastically missing the mark on that one, you guys, because there's already an overwhelming amount of programs for new home buyers. The problem is new home buyers just don't qualify for them, because traditionally, in order to get a bond or a grant, and grants are the ones you want, those are the forgivable down payment assistance programs. People don't qualify for those because of the debt to income ratio. The debt to income ratio is generally tighter on those programs. So being that the housing market is so unaffordable right now, people just don't qualify for those programs. So again, I think honestly a solution would be, yes, to hold the rates above 5%. Well, obviously the federal funds rate will be lower, but they cannot purchase mortgage-backed securities and things like that. But I like what he's saying, keep the rates above 5% and offer more incentives to new home builders, but also more regulation for those new home builders as well, because we do need more homes. But ultimately, guys, the problem is affordability. So another thing would be to tax mom and pop investors. And I would get hit by that, to prevent any type of institutional purchasing, any type of foreign investing. I think those are also super big things. But, the unaffordability, you guys, is here because of many reasons, not just the low interest rates, foreign investing, again, mom and pop investing, many things. And before I end this, let me show you one more time how unaffordable the housing market is. So when we access Black Knight's Mortgage Monitor and we start with national payment to income ratio, you guys, right now it's 40.5%. Now that's going to go down as interest rates go down. This is based on an interest rate of 7.79. So interest rates are about a percentage higher. So this is more than likely going to go down to probably, I would say, the mid to upper 30% right now. But also understand that this is not an accurate calculation of national payment to income ratio. As a loan officer of 20 years, when we calculate the payment to income ratio, or what we call it is the debt to income ratio, we use, things that really exist, like property taxes, homeowners insurance, and the monthly HOA dues. In this number, that's not being calculated. They're only taking principal and interest. So I just wanted to point out that even though that probably is going to go down probably to the 35 to 37%, it's not really that much. It's much higher when we do the taxes and insurance. But even with that, you guys, even with rates going down, understand that even during the great financial crisis, it was 34%. So we're way out of whack right now. Now, the time preceding that was the 70s and 80s. Obviously, the national payment to income ratio was super high then. But nevertheless, you guys, it is unbelievably unaffordable. I'd like to bring viewers to this last bullet point right here, which is basically saying to get back to the long run affordability levels, that would require some combination of interest rates going down 4.4%. Now, we've had rates go down about a full percent. So that would mean we'd need another 3.4% decline in 30-year rates and a 62% rise in median household income and or a 38% decline in median home price. Now, I always try to explain, and at least in my opinion, that price is more important than payment. I understand how important payment is, especially with cash flow and affordability and things, but price is extremely important. So interest rates, understand that doesn't necessarily have an impact on prices. Prices need to go down because the PE ratio is so out of whack. So if rates go down and more people start buying and prices go up, understand the PE ratio, or the bubble, gets worse and bigger. Let me show you. So again, this really has nothing to do with payment, although you can argue that the payments were so low that that's what drove prices up. But this is the PE ratio, okay? So again, the amount of your salary or your earnings into how much a house is worth and how many years it would take. So if I made $100,000 and I purchased a house for $500,000, my PE ratio would be 5. And generally we need 3 to 5. Okay. So usually it's 3 to 5, or that's, healthy. And I would say it's more like 4. But right now, you guys, we're over 7. Okay. You can see that right here. So we have a bubble right now. Okay. An asset bubble right now that is bigger than the GFC, as you can see right here where I'm circling. So the GFC was a bigger bubble than it is now. And I think understanding all of the things that I just showed you is very, very important to understanding what's going to happen next in the housing market, because those are things that are very important to sustainability and longevity of the housing market. Now, personally, I'm surprised that existing home values stayed propped up and rebounded the way they did, but we did not see that in new construction. We saw sales crash, and we saw certain metro areas continue to have crashing prices as well. But overall, especially in tight areas like Anaheim, San Diego, existing homes right now are so overvalued, guys. It's shocking to me. I mean, I really can't believe that it's made it this long. So it's going to be interesting to see what happens as the Federal Reserve continues. Well, I say continues, but as they start, and they haven't yet. So mortgage rates went down 1.5 points, but the Federal Reserve never touched interest rates. Intriguing, isn't it? So it's not just about the federal funds rate. So understand there's many, many things going on here. Now, I do think that we should, again, stay encouraged. If we're on the sideline, just continue to work on your purchasing power and continuing to use the data to find a deal. Remember what I'm saying. I can find homes in some subdivisions in my local market that have crashed already in prices. I found, and just did a video showing you guys, I found a property 10% under 2021 values, okay? 10% under 2021 values. So it does exist. The most important thing here is that every video you watch, you empower yourself, you gain more perspective, or you get additional perspective, but you guys are the ones that have to grow. Understand how important it is for you to make a good decision when it comes to purchasing a home. It is incredibly dangerous and incredibly toxic. So I wish you guys the best of luck. Now, other than that, if you're out there investing in real estate, like I said, I wish you luck, and I hope you win.